Yeah, Kelly, early in the year, I think we highlighted this idea to our clients that asset sales could become part of the mix. And I think, last time they weren't. The Fed really drifted away from that, even though there was a lot of discussion of it in the early days of QE1 and 2. And, they've added $5 trillion worth of securities in 2 years. That's been the primary method for creating this accommodation. And I think it's important to talk about the balance sheet and think about the balance sheet when you're unwinding it, when you're doing your QT. And I think they made it clear that after some time they're going to consider that. They may not do it, but I think just considering it is probably a slight shock to the market. And that's why the 10-year yields have gone up, I think, in the last 24 hours nicely. And the curves re-steepened out. I think 2s10s got to about -8.
Right.
And if I looked at it earlier, Kelly, you've got it in front of you. I don't, but I think
20.
It's, plus 20. Yeah. So that's a pretty hefty change in 30 bips in the curve, just like that.
Is it a sign of success? I mean, if two important things have happened here, and Ian Lingen at BMO pointed this out, that the Fed started getting more hawkish when 10-year break-evens went above 3%. 10-year break-evens are off their highs, 5-year break-evens are off their highs, and the yield curve is steepening. So that would seem to be early signs of the market now validating finally the Fed's hawkishness. And is it the balance sheet in particular you think that has delivered that victory, or is it just all of the measures put together?
So first of all, I think, it's a big, I find it a mistake to look at these, particularly the short end break evens, but even the 10-year itself. There's a 2-year, 3-year window here now that I think we know inflation is going to stay and has been staying quite high. So the Fed's going to look at 5-year forward. We've talked about that on the show a bunch of times. That really hasn't moved, in the last 18 months. It's been 2.25, give or take 20 bips either way. So Fed credibility on the inflation fighting front, as much as people want to bash it, has not really budged. We've got the surge. We know we've got the surge. Whether it's supply side or demand side remains to be seen, but it is there. But the long end inflation expectations in the New York Fed survey, the Michigan survey, and the break-evens tell you that people aren't really worried about a sustained problem in inflation. So I don't think that's it. I think the really question is, and I remember we talked about this when we first wrote that note, Kelly, there's two punch bowls. There's the balance sheet punch bowl and there's the short rate punch bowl. And we're trying to figure out which one they're going to use more of and how they're going to kind of remove punch from those various bowls. And I think we got to look on Wednesday, at the idea that maybe the balance sheet punch bowl after some time could become a more interesting place rather than the short rate punch bowl to take some of that accommodation away through asset sales of agency MBS.
And so let's kind of back up for a second. They want to tighten the balance sheet in part because they just are trying to find ways to basically slow the nominal demand boom we're seeing. So they want to do $100 billion of tightening a month, about 60 from treasuries, 35 from mortgages. But ironically, because of higher rates, people aren't going to prepay their mortgages as quickly as they once did. So the Fed may not be able to just allow those securities to run off and hit the 35 billion number. All of this said, Dave, even if they had to sell, they'd be starting, what do you think, with fairly small numbers? Is there a risk that these numbers could become too much for dealers to handle?
Well, you know what's funny, Kelly, is just making an announcement that you're going to do something and then trying a little bit of something, and all of a sudden it works and it's successful. All of a sudden, that can have a big impact on the market, one. And two, if it works, you say, well, maybe I can do more. I mean, nobody really knows. We didn't try asset sales last time, really. So I think it's just the market was much more prepared for a balance sheet story that was, okay, passive runoff, leave it alone. We're going to focus on rates, just like the 2015-16 liftoff period was put into play. And here it seems a little more nuanced. This is a different balance sheet unwind. And I think that's an important distinction from yesterday. This is one where we might see the Fed come in and sell assets, and that opens a door to something new. And I think the market is thinking about how to price that a little better. And by the way, Kelly, I don't like to talk about what I think the right thing or wrong thing is. I just like to talk about what I think the Fed is going to do. And this is something we did think they would do. But there's a great argument for getting rid of some of these assets a little bit faster. We have a really big balance sheet. We started pre-COVID with a balance sheet that was at 18% of GDP. Now it's at nearly 40% of GDP. And even if we just let runoff go for the next year or two, we're still going to be way above where we were pre-COVID. So we have a big balance sheet that really doesn't make a ton of sense in an economy with a 3.6% unemployment rate and a big miss on inflation.